Welcome to The Explainer. Today, we're diving straight into literally the most devastating financial collapse in U.S. history, the crash of 1929. Now, you might be wondering, why does an event from nearly a century ago still matter today? Well, because understanding the mechanics, the psychology, and the sheer scale of how billions of dollars vanished in a matter of days is absolutely crucial for spotting financial bubbles right now. So let's unpack exactly how this massive market failure acted as the catalyst for the global Great Depression. We're starting off with this chillingly accurate prediction from financial expert Roger Babson, made just weeks before the Great Crash. Babson explicitly warned that a severe correction was coming, and this was completely at odds with the overall optimism of the time. You had prominent economists like Irving Fisher famously claiming that stocks had reached what looked like a permanently high plateau. The tension between these two viewpoints, the doomsayer versus the eternal optimist, really perfectly sets the stage for the absolute disaster that was about to unfold. Okay, so here's our agenda for today. First, we'll cover the Roaring Twenties boom. Second, the ignored signs of trouble. Third, the days of panic. Fourth, the global economic fallout. And finally, the legacy and new regulations. Let's jump into part one, the Roaring Twenties boom. Picture this. It's just after World War I, and America has entered the Hoover bull market. It's an era of immense wealth and just unbridled optimism. The U.S. was going through this massive industrial expansion, and all that soaring confidence translated directly into wild financial speculation. Think about how accessible the stock market became during this time. The public, and we're talking everyone from your wealthy banking magnates to everyday chauffeurs and cooks, rushed to brokers to invest whatever savings they had. It was a real gold rush mentality. People were literally selling off their Liberty bonds and mortgaging their homes just to pour cash into the market. So, the absolute key to understanding why this bubble became so lethal comes down to two words: margin buying. This was a common practice where brokers would routinely lend small investors more than 2/3 of the face value of the stocks they were buying. It allowed ordinary folks to highly leverage their investments. And hey, as long as prices kept going up, it seemed like a foolproof fast track to wealth. But here's the catch. Because of all that leverage, investors stood to lose massive sums of money. In fact, they could end up owing money to their lenders if the market ever turned down. And boy, did they borrow. Get this. By August 1929, an astonishing $8.5 billion was out on loan specifically for margin accounts. To put that staggering number into perspective, that $8.5 billion was actually more than the entire amount of physical currency circulating in the United States at the time. The whole system was basically resting on this colossal, fragile foundation of debt. Fueled by all this borrowed cash, the 9-year bull market finally hit its absolute ceiling just after Labor Day. On September 3, 1929, the Dow Jones peaked at 381.17 points, having increased tenfold over its run. But right after this peak, things started to falter, experiencing what the press dubbed the Babson break. However, a lot of amateur speculators just looked at that dip as a healthy correction and a brand new buying opportunity. That brings us to part two, ignored signs of trouble. You see, there was this dangerous, really massive disconnect happening. While investors were buying up shares in an absolute frenzy, the actual physical economy was slowing down fast by mid-1929. Consumer goods were just sitting around unsellable because everyday Americans didn't have the purchasing power to buy them. Auto sales were dropping, steel production was sluggish, and the agricultural sector, it was deeply depressed. Really good harvests had actually created a massive 250 million bushel oversupply of wheat, which totally tanked wheat prices and threatened to wipe out farmers' incomes entirely. And to make matters worse, the Federal Reserve had already started tightening credit to cool things down, raising the discount rate to 6% in August. Combine that with a boom in utility holding companies and investment trusts that were creating these complex webs of debt, plus a huge number of large unliquidated bank loans, and, well, the camel's back was severely overloaded. Which leads us to part three, the days of panic. All right, let's fast forward to late October 1929. The realization finally hits that prices can't rise forever. The really severe selling kicked off on October 23rd, but the first true day of sheer panic was Black Thursday, October 24th. A record 12.9 million shares changed hands. The volume was so insane that the ticker tapes reporting prices across the country fell hours behind. Imagine that. Investors had absolutely no idea what their life savings were currently worth. That blind uncertainty just threw gas on the fire. After a brief weekend pause, Black Monday hit with a devastating 12.8% drop. And then, the climax, October 29,
Black Tuesday. Over 16 million shares traded, and the panic peaked to the point where some stocks literally had zero buyers at any price.
Now, it's pretty fascinating to see how the financial establishment tried to fight this off. During the chaos of Black Thursday, top Wall Street bankers held an emergency meeting, pooled their money, and sent Richard Whitney onto the trading floor. He boldly started bidding $205 per share for U.S. Steel, which was way above the current market price, and did the same for other blue chips. This exact tactic had successfully stopped the panic of 1907. It even worked temporarily here, rallying the market for that day. But ultimately, the sheer tsunami of selling was just too immense, and it totally failed to prevent the absolute carnage of Black Monday and Tuesday.
To really wrap your head around the devastation, just look at these blue chip valuations. We are talking about the absolute titans of American industry falling like fake gold mine stocks. General Electric plummeted from 396 to 210. RCA's common stock? It faced total annihilation, dropping from 505 all the way down to just 26. This aggressive repricing completely wiped out thousands of smaller investors who had bought these safe stocks on margin, leaving them facing massive loan calls they simply couldn't pay.
Let's look at part 4, the global economic fallout.
The collapse of Wall Street sent shockwaves way beyond New York. It acted as the primary catalyst for the worldwide Great Depression. And despite politicians promising that prosperity was right around the corner, the bleeding didn't stop in 1929. It kept grinding down for years. It finally bottomed out on July 8, 1932, with the Dow closing at a dismal 41.22 points. That is an agonizing 89.2% wipeout of its pre-crash value. Just brutal.
The collateral damage was unprecedented. Wealth evaporated, consumer buying power vanished, and businesses shuttered, leading to mass unemployment. Around 4,000 banks ended up failing. And because the global economy was so tightly knit, the crash triggered a worldwide run on U.S. gold deposits. Over in Europe, it was severe. In the UK, mass unemployment led to massive public strikes and violent clashes with police, as working-class people fiercely protested the government's intrusive means test for unemployment benefits. Finally, let's wrap up with Part 5, Legacy and New Regulations. So the events of 1929 completely shattered public trust. The government had to step in and fundamentally restructure the financial system to make sure this never happened again. Before passing new laws, the Senate set up the Pecora Commission in 1932. Their job was to dig into the root causes, exposing the speculative abuses, the dangers of holding companies, and the incredibly risky behavior of commercial banks that had been gambling their depositors' money on the stock market. Congress essentially rewrote the rulebook. First up, the Glass-Steagall Act of 1933, which legally separated your everyday commercial banking from the riskier investment banking. Then they created the Securities and Exchange Commission, the SEC, to mandate transparency and outlaw the blatant market manipulation and insider trading that fed the bubble. They also threw in structural safeguards like the uptick rule to stop short sellers from aggressively driving prices into the ground. Stock exchanges around the world even added circuit breakers to simply halt trading if prices dropped too fast. So, as we look back at the billions of dollars wiped out and the decade of global misery that followed, it really leaves us with one massive question. Despite all our modern regulations, circuit breakers, and government oversight, are our markets today actually immune to that kind of irrational exuberance and debt-fueled speculation? It is definitely something to keep in the back of your mind the next time you hear someone say the market has reached a permanently high plateau. Thanks for joining us for this explainer.